really a few week long, anywhere from 3 to 5 weeks long, bit of a ongoing discussion on charting techniques. Just by a quick vote of honesty, who has or who does now or has ever used charts that look like this? Me. I'm guilty of that. Do you ever find that when you used a chart like this, you never knew where to buy it? So you'd convince yourself that, if all these little squiggly lines down here point up, and then I cross above all these little lines down here or up here, if I get above all of those, that's where I buy it. Has that ever been you? It's been me. And then it seems like by the time you cross all those lines, you're just very, very short of another line. So even when you do get some profit, you kind of cut yourself short, only to watch it keep running with no little lines or squiggly things to tell you to do anything. So then you get this idea of, well, I got all this crap on my chart, but let me go and draw some other stuff. You start putting lines like this on your chart. Maybe you heard somebody talk about like these Fibonacci things. So you start like drawing these all over your chart. Before you know it, you got a chart that looks like this. That ever been you before? I'm guilty. By the time you put all the harebrained ideas together, what you end up with is absolutely confused. Is that a pretty simple and realistic assessment? You simply end up confused. I'm a firm believer personally that you should not put anything on your chart that you're not willing to trade. So, some of you might be honest, some of you might not be honest. You don't have to be honest with me, just be honest with yourself. If you have a chart that looks like this, you know, just so you guys know, what do I have on here? I have Bollinger Bands. I have a 200 moving average, a 50 moving average, a 34, a 21, an 8. I have a MACD, I have an RSI, I have a CCI, and I have just a full stochastics. Whole bunch of stuff. If you are not going to buy and sell every time one of these gives you the signal to do so, take it off your chart. Just take it off your chart. Because if you're not willing to buy and sell every time one of these gives you a signal to do so, then you're just going to confuse yourself. There are some charts out there that will trade phenomenally with a 21 simple moving average. There's some charts out there that'll trade phenomenally using a MACD. There's stocks out there that'll trade great using channel lines, trend lines. Stocks out there that'll work good using Fibonacci's. Do you think any of those things works for every single chart? Consistently and to a high percentage? Absolutely not. If they did, if there was some foolproof trading system out there, that'd be the only thing anybody ever talked about, and there'd be no debate. I'd have done one webinar 2 months or 2 years ago, and basically I just re-show the video every night. But there are so many different things that really need to be put into your own personal trading arsenal. And each one of them's pretty well, I'd say, equally important. Do you see a difference visually between a chart like this and maybe a chart like this? We'll go back to this one and over to this one. Now we're kind of gonna look at both of them equally. Let's start back over here with where I'm from. We would call it a cluster and then insert F word here. But I don't want to do that. I want to be a little bit polite here. When you look at something with all this clutter, let's truly look at what it might be telling you at different times. Now, with my Bollinger Bands, just so you know, the pink line is the center line. Some people use a 20 setting on their Bollinger Bands because I use a 21 SMA on some things. I just set them to 21 so it'd be consistent. But, you know, the Bollinger Bands in general, you know, they're a measure of volatility. So is seeing movement in the candles. But there's really two sides to the Bollinger Bands, the upper channel, the lower channel. Typically, when the stock is in that lower channel, people look for bearish trades. And when it's in the upper channel, they look for bullish trades. So, for instance, using the Bollinger Bands alone here on GE, we'll just go back in October time frame and we'd see the time where it crossed the center right here about the 21st, 22nd time frame. That might have been an indication of a buy for a lot of people. I'm going to scroll this over a little bit so people can see kind of what I'm talking about. Do you see where on this day you crossed over that pink line, which was the center of the Bollinger Bands? Does everybody see that? Now, when your chart looks like this, what do you see that might make you a little bit reluctant to buy? What do you see on the chart that might make you a little bit reluctant to buy? That means like hesitant, not willing, scared. A lot of times what people would say is, okay, it crossed that line finally. And it went and hit this line. Okay, so, oh, it pulled back from that line. So that line must be a good one. Oh, it broke that line, but it hit another line and it pulled back, right? Okay, well, it broke that line. Maybe I'll buy it here and I'll sell it at this blue line. Oh, crap. It went back under my red line. So I'm going to stop out of it, and I now hate this stock. Why do I hate this stock? Because it made me have one losing trade. Oh, well, crap, now it just went up to my blue line. And it pulled back. Crap, that's what I wanted it to do. Okay, it broke above my red line again. And there we go. It broke above my red line, and I was able to get 23 cents on the trade because once it broke above my red line, I had to trade it to that little teal colored line, that bluish colored line. Oh, guess what? It came down to my red line again. And there it hit my blue line and pulled back. I guess I better sell it again for what was about a 16-cent gain. Oh. And that's usually how it happens, right? When you have all that clutter on your chart. You have all that clutter on your chart, or here's the better part. You have all the clutter on your chart and things are, let's say you're long in the stock and you tell yourself, you know what? If it comes down or if it bounces off that yellow line, I'm going to buy it. Okay, cool. Well, you're looking good. You're looking good. Okay. Hey, it's, uh-oh. If that yellow line was what you were using to dictate your buy, shouldn't you also use it as your sell? But see, here's what too many people do. With all this clutter on their chart, they say, well, I don't want to sell it here because what if it just goes down here and hits that line? Well, in theory, that's pretty good. You ever done that before? I know I should have stopped out there, but I got this other point that it could probably bounce off of over here. Oh, crap. That don't look good. Well, you know what? Maybe it'll bounce off one of these lines right here. Yeah, I'll be okay if it bounces off of one of those lines. Oh, okay, it's bouncing off one. Uh-oh. 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 Uh-oh, I'm out of lines. I'm all out of lines. What do I do? Well, I'll wait till tomorrow and see what it does. Oh, no. Well, it's a green candle, so maybe since it has a green candle, it'll go up. Oh, man, this is, oh, Lord. Has that ever been you before? Sometimes when you have all this crap on your chart, it gives you false hope. Not only did I find in my own trading when I would, when I was first learning and I'd go to places, other services that would have you put all this crap on your chart. It's like, wow, these guys are really selling themselves short. Because when they actually do get a winning trade, it's really, really small. And they might pick good stocks, but man, they're only getting a little portion of it. And I'm not saying that any one of these things is bad. But take a good look at this chart here, kind of ingrain it in your mind. And if you want to be dependent on an indicator of some sort, then feel free to use that indicator, whatever it might be. Things look a little different now. Let's just talk about that same time period we kind of walked through. If somebody was using the Bollinger Bands and looking for a long trade, a trade for an upwards direction, typically when it's in the lower half of the Bollinger Bands, you're either going to be short or waiting for your long play. As time goes on and you're waiting and waiting and waiting, and you break above that center line. This is many times viewed as an indication that you might start to go the other way. So now, as opposed to the last time we walked through this time frame, what makes you hesitate to buy here? What makes you reluctant to buy? You remember on the last chart, we had a whole bunch of lines in the way, didn't we? Now, I can tell you, and I can darn near guarantee you, there is not a trading system out there that'll guarantee that you can buy the absolute low and sell the absolute high every time. So get that out of your mind. Not going to happen. But there's a lot of consistent trading systems that, should you focus on, you can find trades regularly and do well on the majority of your trades. So let's go through, if we bought it here, now we got a red day. If I bought it because it shifted over to the bullish channel of my Bollinger Bands, do I need to exit out of the trade here just because it had a red day? Is it a bad trade all of a sudden? Absolutely not. Oh, look, the next day it starts to kind of go up. Now, if I'm using the Bollinger Bands, many times people would use the upper or lower band as like a support or resistance, depending on the direction they were trading. So let's just watch that upper band. And as you can see, we don't have any lines in our way. We don't have any confusion here. And over time, this line started to point upwards, didn't it? Well, if that's going to point upwards and that's our resistance point, then that means each day that it continues upwards, we have a higher resistance point. Now, as time goes on, you can already see that, okay, I finally hit that resistance point. Now, even had you bought at the close of the day here at 25.45, let's say if I was trading using any indicator via options, what type of strike do you think I would use if I was going to use any indicator to trade my options? What strike? What type? What is going to move most likely? There you go, Joshua. In the money. In the money, because it'll move fairly close to a penny for penny movement with the stock based on something called intrinsic value. And because, let's face it, you never really know when your indicator is going to give you the sell signal, do you? And I've seen a lot of people like, well, I bought because the MACD pointed up. Okay, that was 6 months and 40% above where we are right now ago. Why didn't you sell? The MACD pointed up. Well, yeah. So whatever type of trade system you're going to use to make the buy, use it to make the sell. As you can see here, the Bollinger Bands, would they have not produced a winning trade? Okie dokie. So we're going to get rid of our Bollinger Bands. And we'll look at another upper indicator. Just a simple 8 simple moving average. A lot of people like the 8 moving average because it's a shorter term moving average. If you're going to trade a moving average, you need to trade the direction of the moving average. So let's look at what the 8 moving average did around the same time. I crossed the price, but it's not until this day that it starts pointing up. And on the next day, I go ahead and I can make my buy. You can also feel free to, at the close of this day, make your buy. So as you can see with the 8 simple moving average, you basically would have got in at or close to the same price as the Bollinger Band. Did it get you the absolute lowest buy? Now some people can say, well, right here, this wick, it crossed above the 8 moving average, so we should buy there. Well, that means you went long right here, right? When it crossed above the 8 moving average, right here, or right over here, and then just got lucky if it came back for you. But as you can see here, we'd have been buying that anywhere between 25 and 25.45. And we could simply use the direction of the 8 simple moving average to guide us through the trade. And here, the 8 simple moving average pointed down. If I went from the day it pointed up to even the close on the day it pointed down, would it have produced for me a winning trade? Yeah, that's kind of undisputed, right? Now, it wouldn't matter if it kept going up, down, or whatever else later. Even on the downside, had I went short when it was pointing down, and even right here, it actually was still flat this day. This day it started pointing up. I still could have had a winning trade. So far in the 2 examples I've walked through, have either of them gotten you the lowest buy or the highest sell? Mm-mm. But did they produce winning trades? So let's take a look really simply at a couple lower indicators. MACD's pretty popular. So we'll take a look at this chart with a MACD. Now, there's 2 common perceptions of how to use the MACD for your trades. One would just say, and actually let me change the colors of these just so it's more consistent with what most people would have on theirs. This would be a green line. And this would be a red line. And people would commonly say, if the green line crosses above the red line, you buy it. And if the red line crosses above the green line, you sell it. You guys heard that before for the use of the MACD? It's funny, I know a lot of people say they've heard that for the MACD, but so many people will actually tell me in reference to the MACD, I bought because the MACD said so. And I'm like, what about the 30 times it told you to sell? Well, I buy using the MACD. I don't sell using the MACD. The other common way of using a MACD, it's a moving average convergence divergence. It's another squiggly line I don't use. Another way of using the MACD is kind of a 2-part, using that symbol of the green line crossing the red line, but also you see these little bars here kind of look like volume bars. Those are called the MACD histogram. And using the green line above the red line in conjunction with the histogram going above the 0 line. So one of 2 things, you could have found, hey, my green line crossed above my red line, and actually you can barely see it, but the histogram went positive. So this right here would have been a buy signal using the MACD. You would have wanted to wait till the close of the day if you're using the daily chart, and you could have bought that, we'll say 24.25. That's the daily closing price. As time goes on, your MACD is going on and on and on and on and on. And by the way, my basic mindset behind if you're going to trade using an indicator, your chart should actually look like this. And you should buy and sell solely on what the indicator says. So right here, your green is below your red line. If I bought because my green line crossed above my red line, then what should I do when my green line crosses below the red line? Sell. Now, in this particular case, it crossed with a closing price of 25.25. And even though this is a green candle, the downwards cross day was at 25.70. Might not have been a big winning trade, but would it have produced a winning trade? Absolutely. Now, let's go on and look just a little bit right here. my green line crossed above my red line again, which would have me buying again at 25.82. And selling on this day when it crossed back below at 26.42. Would that have produced a winning trade? From a buy at 25.82 to a sell at 26.42? I think so. Oh, it just crossed again and told me to buy at 26.61. And there it crossed below with a closing price of 26.99. 26.99 minus the buy price of 26.61. Could that have been a winning trade? I think so. Below with a closing price of 25.27. Is that price higher than where your buy price would have been at 25.14? I think so. You know, people can sit and look at something like this all day long and say, well, that seems really easy. And then they put it on their chart, and what ends up happening? Let me show you exactly what happens. We'll go back to this last buy signal. Gonna buy because my MACD says buy. My MACD just said sell. But you know what? I didn't make enough money yet. So I'd rather it keep going down, right? I mean, that's truly what you're saying. I didn't make enough, so I'd rather lose. And that's what you'd be saying if you didn't sell when it gave you the sell signal, correct? Very, very simple. You might not say that out loud, but your action is saying that. So, you know, even indicators can be used. There's another buy signal. You got a quick sell signal, and the next day another buy signal. Would have been a winning trade anyway. Here's another winning trade that it would have given you. These indicators can be used fairly well. But let me tell you another main problem people have. We'll just go back to this last little run area here. They'll come across the chart where the MACD crossed on this day. And here you are 1, 2, 3, 4, 5, 6 days later. And they're watching it and they, okay, my MACD crossed way back here. I'm gonna buy it. Just like anything else in trading, any type of trading system, when's the important time to buy it? It's not at the absolute low, because there's no trading system that'll give you a consistent buy and sell signal at the absolute low and the absolute high. Those prices are determined by who's buying the most and who's selling the most. It's when you buy it when the buy signal is given. Because remember, as we walk through a few of these other ones on a MACD, sometimes it might only been like 15, 20 cents, but it was still positive if you followed it. But, you know, you come across a chart and it's like, oh yeah, let's go ahead. Man, that MACD is curling up. Oh crap, it just curled down. Well, let me hold it and hopefully I get lucky. And sometimes you do. But do you see how much more clear you can see a chart if you maybe reduce the number of indicators you're looking at? Let me remind you, here's a chart with one indicator. And a lot of times when I talk to people and say, you know, we might go into like the GoToMeeting, I say, well, let me see your chart. And by the end of it, I'm like, is there a chart in there? Did you have a chart somewhere? I see a whole bunch of stuff, but I don't really see the chart. And it's because they have all of this stuff, all of this stuff. And back here when the MACD said buy, yeah, well, you know, my stochastics is still under 20, and I read somewhere that the stochastics under 20 is not really a time to buy. I got to wait for it to come over. Well, now the stochastics came above 20, but I'm right at this yellow line, so I guess I got to wait for it to break that. And, you know, now it's kind of coming up. Okay, I guess I'll buy it here. And then I get up in here and my CCI just peaked, and next day it kind of starts coming down. So I guess I got to sell it. And oh man, I'm so confused. I don't know what to do. And I'm telling you, if that's ever been you, stick to something more simplistic. If you desire to use an indicator for your trading, then use the indicator for your trading. Pick an indicator that you can easily read the buy and sell signals and follow it. It'll do you a lot of wonders, believe me. But there's also a big difference between a chart that looks like this, a chart that might have one indicator on it, and a chart that might look like this. Now, I'll be the first to tell you, I could argue both ways as to what would be the better thing to look at, a chart with an indicator or a bunch of indicators, or just what I call a naked chart, one without all them squiggly lines that confuse the snot out of me. Yeah, that's why I started going to the naked charts, because to be honest, I when I would look at this, I simply got confused. And I went to something like this where you can apply some more simple tactics. Often you'll hear me say trading is a game of highs and lows. You guys have heard me say that before, right? Whether it's lower lows and lower highs or higher highs and higher lows. Basically, that's what trading is determining lows and highs. Would you agree? So no different than maybe waiting on a signal for an indicator. I could come and look at a chart like this and say, okay, and you guys know I like to use the closing prices, not the wicks and stuff that happen erroneously throughout the day. But I could say, you know, that close, that's a lower low than both of these, right? You had a low right here, that one's lower. Even way back here, this one's lower. So whether I was using this low right here that led to this high, and I'll just go ahead and put a line and color that one green, or I was using this low right here that led to this high. Any expectation I would have after a lower low would be what? A lower high. Which means that I would not necessarily be targeting either of those 2 points with my initial trade, correct? So at this point, and actually it would be back maybe on this day, I may be looking for the opportunity to do what with a stock that's making lower lows and lower highs? Short the stock. I can short it via shorting the commons or playing the puts, going long in puts. But then on this day, something happened. Had really good earnings. So wow, okay, I might need to look for a long play. But this long play at this point in time should still not target anything higher than this high, right? Because if it was going to go higher than this high, that means it would have to break this high. And I know this sounds very, very simple, but it is. Now, if I see a stock that's been bludgeoned to death, but it just had really good earnings, I've got two choices. Jump on it, or maybe wait for what indication that it might stop going down. A higher low. Okay, so this is very, very simple. I basically say, hey, this thing just beat on earnings. I'm going to watch a pullback, and I'll let this first run happen, but I'll watch for a pullback, and if it gives me a pullback, I'm going to go ahead, like, if you're using TD Ameritrade charts, you kind of have the luxury of playing with them a little bit, and I'm going to make this line like really thick. Why? Because I can't close a day below that line and still have any justification whatsoever for a long trade, right? At least for me, I like using the closing prices, not the wicks. And that means it can't close below that line, right? No close below that line for me to justify a long trade. That also means that if I'm wrong on a long entry, whether it be common shares or calls, maybe I try to call a low and whoops, that wasn't the low. Can I have a little bit of downside tolerance? Absolutely. Down to this line. Because if it closes a day below that line, I have no justification for my calls. So as time goes on and I'm kind of waiting for it to pull back, is this maybe an indication that a pullback is over? Well, I mean, you can look at this in one of two ways. I wouldn't necessarily go long as it was falling, but I was expecting a bounce at a point higher than this thick red line, right? Because we had really good earnings and things might change with it. So I'll let it play out, see what it does, and I think we'll get a bounce higher than this thick red line. So with this green candle, if I wanted to take the opportunity, I'd need to put two lines on my chart. First is this one, and it won't be a thick line. It'd be a little thin line just to indicate that, hey, that's where it had pulled back to and made a positive move from. And the other one would be at my last high close, which would actually be the bottom of this red candle, because on a red candle, you opened at the top of the body, you closed at the bottom. And I like the closing prices. So now, if this was going to be my low and it is higher than this low, what would my expectation be for this green line? That will break it, right? Let's keep it real simple. That we will go above it. What kind of chart are we building right now? Swing point chart, right? We are marking swing highs and swing lows. Now, whether you're using this for a long-term investment or for even just an individual trade, let's just keep it simple and say that if I did want to take the risk of making the buy on this day, I still need to understand that if I was wrong on this low, it doesn't mean I was wrong on the trade unless it closes below this line. And then guess what? Didn't matter what the earnings were. It's not time to go long. Does a day like this need to spook me, even if I would have waited and bought at the close on this day? Gap down the next day, shot up, and then came all the way back down to where it opened. Does it need to scare me at all? The answer is no. And as time goes on, do I need to even fear this red day in association with my trade plan? You know, 1 out of 10 times, 1 out of 10 times it'll keep going down. And you know what? At this point, if it went below that 2360, you'd stop out and say, oh man, if I would have just sold because that candle went red, okay, and maybe I should have done that. 1 out of 10 times. But what am I looking at as my expectation for this trade? Keep it real simple. This first initial trade has an expectation that we will do what? Close a day above that green line, right? And I am keeping it very, very simple because it truly is very, very simple. And over time, do I need to even be scared and maybe sell on this day? And the reason I'll say no is because if this low was truly going to be my higher low, then I should close a day above that line. Now, there's nothing saying how far above that line it has to be, but it shouldn't close a day below it. And at this point in time, what do I have to begin to look at for where my trade could be over? If I'm in a long-term investment based off of this, after a higher high was made, higher high close, if the thick line indicated my stop, trade long-term investments based on your stop, not the price it's at. Because if you start trading a long-term investment, you're never going to be in anything very long because you're going to try to guess the high and you're probably going to be wrong a lot. But really, at this point in time, if I was making a long-term investment based off of that, I'd actually even delete this line. Why? Because if it goes below that red line, I don't need to be in it. So it doesn't matter what red line was down here, because if it closes a day below this one now, I don't want it. See, now what I've done is in trading according to the stop, I've been able to raise that stop higher, which means, at least at first, I would not lose as much as what I had originally had to be able to be willing to risk should I now get stopped out. Now, if I'm just trading, where would I want to now make my stop? at a close below the swing high. At a close below the swing high. Now, once something like this happens, do I have a visible up move? And even though it's just one candle in this incident, or in this instance, do I actually have a visible down move? Do I have a day where it's like, wow, that's definitely lower low, lower high? Which means I need to mark a swing high point and you know what? I wouldn't necessarily sell here. But any low that's higher than this low would still be a buying opportunity, correct? If I now have a bullish sentiment for that chart, any low that's higher than this low would be a buying opportunity. Now, sometimes you can't really tell what a low is right away. But remember, any higher low that leads to a higher high is a justifiable low. So even if this happened, and you said, well, shoot, now I'm right back up that swing high point. Now it looks like I might be pulling back from that swing high point. And then this happened. I need to now take this, and even if I'm in a long-term investment, I need to now make this line thick. And in reality, this line doesn't even matter because any line below my stop doesn't matter, does it? Any line below my stop basically does not exist because it shouldn't matter. Don't even have it there where you might convince yourself that, well, even though it failed my stop, I can hold it because there's another line not very far away. You know, even I'm guilty of doing that at times. It's a hard discipline to get through. It's something that's actually easier to talk about not doing than to actually execute by. But if you simply annotate on your chart based on what your trade plan is, you will have a better understanding of how to use that trade plan and be confident in that trade plan. At this point in time, is there really right now any reason to try to debate with yourself that you'll get a daily close below this close right here, this 2501? I mean, we could spend all day trying to debate whether or not it could. You know, it very well could. But so long as you're trading in this type of pattern, if you keep convincing yourself that, well, I don't know if it can go up anymore, or, hey, I'm making higher highs and higher lows, let me buy puts, then you kind of run into a problem eventually. Actually, it's not even eventually. Usually it's fairly quick. Stay consistent with it and keep building upon it. Now, in this example here that I've gone over, we actually use swing points on our chart to help establish things. I want to go back just a little bit, though, because when we were talking about using indicators, we talked about if we were going to trade via indicators, that we needed to trade what types of strikes. What strike did we need to trade? in the money. And in the money options can typically be what? Keep your answers simple. More expensive. Thank you, Margaret. So if I'm using swing points, and at this time where I say, I think this is my high or low, and this here, I believe that I will at least close a day above this green line. And this green line is valued at 24.59. If GE has 50-cent increments with their strikes, do I have to take the 23.50 call because that's the one in the money on this day? Or can I take something as high as the 24.50 because even though it would only be in the money by 9 cents at that line, I'm expecting it to break that line with the close of a day, right? And these are things that can help you very basically, very, very, very basic. Because down here, if you took like the $27 calls because there's a high up here at 27 bucks, do you think it's possible that stock goes up and calls go down? Is that possible? Let me give you a good example. Last week, I had GS 220, 200 calls, and 205 calls expired worthless. The week before that, they were still worthless, but it was at 172, and last week it hit 190. It moved up like 20 bucks. Did that help my calls? It's a perfect example because just making an up or down move alone does not mean you will make money on calls or puts. Knowing what strike to justify buying. Are you always going to be right? No. But there's a justifiable reason based on a trade plan and a trading system to make that buy. So with what I've walked through here on this chart right now, does everybody understand like how I got my swing points and how I walked through the establishing where we had higher low, higher high, and where you would make the buys using that? Does everybody understand that? Okay, so what we're going to do now is look at a couple other charting techniques. So let's take a look at a couple other charting techniques. And I guess real quick what I'll do is let me put my other swing points on there that I had just because some people might see those and go, hey, that made a lot of sense to me. Finally, swing points are the most simple, most basic and simple to understand of all type of trading senses. It's just visible moves up and down. Not every red or green candle, but moves. Like I can see that it went up and it went down. And now it's going up, then it went down, and now it's going up. So if you'd like that chart of my swing points on GE's daily, there's the link right there in the chat room. And I'm going to go ahead and I'm going to remove the drawings now. And now we're going to look at another type of scenario. We're going to use one of my favorite things to use is Fibonacci extensions. And, going on that same thing we talked about, hey, there's a fundamental change. It had really good earnings. I want to look and see where it could pull back to. Now, I try to get all fancy and, I might use this little blip up ahead and this little down move and maybe use something like this to try to judge if it replicated that down move from now this point, where would it go to? Let's see if I'm even close. Hey, it looks like I was close, right? Wouldn't you say it looked like I was close? Okay, well, if I was expecting it to come down to that price and it did, and then it went up and I was waiting on a calls trade, what should I do? I'm going to stop you. I don't think your answer is buy right there. Your answer is first to say, okay, well, I had a little blip and a down move, so I'm going to kind of use this candle here. I'm going to go up to my high. I'm going to go to my low. And I'm going to start by saying, hey, it hit my pullback target and started moving up. So I think that might be a buy. Where could it go to? Should it go up? Make sure I got these on the right spots. There we go. So now, the same type of thing as with the swing points. I was expecting that if this was a higher low, that I would get a higher high. But unlike the swing points where I had to be a little bit lenient down to the downside, what do I have now as this zero line? What is this zero line to me? Stop price. Okay, so let's make it easy. We're going to color code our trade plan. We're going to turn that one red. And if that one's red, what word would we use for this 100% line? That would say, just like I said on the down move, if we were to make the same up move from this point, that would be what we would call our target. So I'll color that one green. Now, just like we talked about with picking a strike, if I'm trading via an indicator like a MACD or a moving average, what do I need to be trading? What kind of options? In the money, out of the money, in the money. But like with the swing points, I actually had a point to judge for. I had, when we went through the swing point example, I had a lower or a higher low, so I expected a higher high. I used the high close and said, hey, that was 24.59. I need something that'll go in the money by 24.59. Well, now I actually have a target price. So with 50-cent increments on the strikes, with a potential buy coming, what strike do I buy? From here, I could take like a 23.50, a 24, a 24.50, a 25, 25.50. I would just really want to take one that would go in the money or would be in the money at my target. I won't always say closest to the target because, if you're trading on a weekly chart that's something that might be 6 or 7 months out, you don't want to lose a lot on time decay. But on something like this, where the last move only took 1, 2, 3, 4, 5 days to hit the high, chances are if I'm using on my daily chart, trading out on the monthlies, giving myself at least 4 to 6 weeks, that if I'm 4 to 6 weeks out, 5 days is not going to see much time decay on my trade, right? Probably not going to see much time decay, am I? If I'm 4 to 6 weeks out, and it might only take 5 days. So let's see. Oh, crap. Here I waited. I did everything I thought I was supposed to do. I bought at the close, and now the next day it's down. Is there any reason to panic right here? Absolutely not. I know where my stop is. Is there any reason to panic here? What about here?
Oh, it looks like we're going sideways. What do we need? I mean, if it's going sideways for, 2 candles, come on. Better send Coach Mike a private message in the chat room. What might I want to do here? Keep in mind, we're talking about trading. We're talking about something that I've said several times tonight, that there is no trading system that will consistently give you the lowest buy and the highest sell. When I made the buy, I said, hey, I think I can get it up to 25.22. It got a penny off. It hit 25.21 this day. Looks to me like you were probably right on your trade, right? We're not talking about a long-term investment. We're not talking about the what-if game everybody likes to play. But what if it keeps going up? For this individual trade complete. Now, one thing I do like to do on one like this, back here at a time like this, let's say it goes up here again, I'll now take like from this low to this high to this low and say, you know what? We're going up. Yeah, I still like my trade to 25.22. So even at that open, why not take, what strike would I take if I was looking at 24.83 as a target? $24.50s. And then my zero line, if I took 24.50s, would be my stop on the 24.50s, right? This down here is my stop on the 25s. This would be my stop on the 24.50s. What might I do here with my 24s? Or my 24.50s, sorry. Now I know in this case it's not that big of a move, but again, we're talking about trading. I bought 24.50s. There's a reason I didn't buy 26s because I had a 24.83 target. You know, at this point, you got to be thinking, well, what if it doesn't get to my 25.22? At least I'm up a little bit on my 24.50s. They're in the money now, right? Let me sell them. Oh, crap. I'd much rather look back at something and go, man, I wish I wouldn't have sold that for a profit and kept holding it, than saying I wish I would have sold it before it did this. And sadly, you're going to have a lot of times where you say, I wish I would have sold it before it did this. But even here, we'd have taken a quicker profit and get rid of those that broke our line. And we're still, again, looking this day for an exit. And then what's to do the next day? Just punishes us for doing what we were supposed to do. And now this day comes. And then this day. Now, when you use Fibonacci extensions, understand that it's still based on visible up and down moves. I'm going to delete this set because that target was already hit. Is it possible that all of this from this low here all the way to this high is one visible up move? Okay. So we got a low, a high, and a low. Is it possible that you had a visible up move here, a visible down move here, and then everything else has been one visible up move? So a low, a high, and a low. Now don't let yourself be confused here, because what you have here is not confusion. you'd have the same stop for two different trades. But you'd have two different targets, right? An opportunity to take profit a little sooner, just in case it doesn't hit this one. Now, with a target price of 26.01, you have to think, what if I hit exactly at that and then pull back? Would a 26 call really be in the money if it hit that price and pulled back? No. So for my 26.01 target, I might want to take 25.50 calls. For the 26.32 target, I could take the 26 calls. Now, like on this day, you could have got the 25.50 calls for like 16 cents, and you could have got the 26 calls for like 6 cents. And here we are basically at this time here, which is current time. What would we be doing? Just waiting, right? Waiting on it to either fall below 24.80 or hit one of these targets. What do we need to do in the meantime? Do we need to try to pull up a 1-minute chart and guess every high and low? Sell calls, buy them back. So, because if you tried that on one like GE, it might only move like 5 or 6 cents, but on your chart look really weird. Your broker will love you. You will make no money. Now, if you get to the point where you feel like you want to be a little more advanced with something like this, I want to go over a little bit of something that I do a lot of, but it's hard to relay this into the chat room in a way that doesn't get me 700 emails a day of people just confused beyond belief. But in a way, I've tried to integrate it a little bit like with our focus group. If we go back to this original little setup here. And then something like this happens. Now, usually when I'm making all these buys, I take what would normally be one swing trade position and I divide it by 3. So I scale into it in thirds. But, let's face it. On the days when you're sitting in the chat room, you're staring at the chart all day and you see this red candle, do you really have that feel good sense that it's going to keep going up? Let's be honest with ourselves. I know the answer is no, because if we're ever in calls on a day like this, and then this day happens, I got all these little flashing orange lights, little tabs in the chat room, private messages. I checked my email, and I got tons of those too. Oh my God, did you see GE made a red candle? No, I'm not looking at it at all. I just ignore everything. So what you could do is kind of play both sides. Now I'm going to color these kind of weird here, but in conjunction with what we've been talking about. Where the 100% line, I'm making it green, that's my target. The 0 line, I'm making it red, that's my stop. And if I feared too badly on my $25 calls, I could say, you know what, I might go down to 23.42 and I could take 23.50 puts. Where would I stop out of the 23.50 puts? Where would I stop out of 23.50 puts if I took them here? Yeah, goes above 24.53. I mean, even if it goes a penny above that, it'll make my target not good, right? If it goes to 24.54, that target's going to move up. And then on this day, I'd say, man, I didn't need to be scared of that. But now I got a puts position. I might want to take me some 24.50 calls. On this day, what do I have to do with my puts? Stop out. Now, you might think, oh, this looks really, really bad. But unlike this candle that it went down all day long, this is very, very close resemblance to a doji. It'd be called a gravestone doji. But any type of doji, what does a doji candle tell us? And if you say reversal, I'm probably going to prove you wrong. It says watch my next candle. So before, even though I would have stopped out of the 23.50 puts, and I say, well, shoot, it gave all that up. I have to watch the next candle before I would get other puts, right? So now here, yeah, I took a little loss on one set of puts. I just take a gain on a set of calls, and I got a set of calls. Now here, even though that's that same type scenario, kind of a doji candle, I'd be out of every position right now, wouldn't I? And I would start looking and tell myself, if this thing keeps going down, where could it go down to? See, I've got this high, this low, that high, but I also had that visible move right there. So I'd mark it like this, and I'd say, man, it's almost down to one of the targets, isn't it? So in this type of scenario where I have two chartable reasons to have two different Fibonacci points, I'm going to confuse you here. I'd say, well, if it breaks below 24.84, I guess I'll take the 24.50 puts. Do you understand why I'm fine not getting the lowest possible buy or the highest possible sell? But what I don't want is for me to take puts here, it drops 16 cents, and make the next bounce. So there's a good chance that if it drops below the 24.84, it could come down to 24.19. So, you know, that day or that evening when I'm looking at my chart, I'd say, okay, that drops below 24.84. I'm going to have to take 24.50 puts, blah, 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 blah. What did it just do? Yeah, I would have to agree with you there, Joshua. Now, this 24.19 target, I would still leave this here. I wouldn't be buying puts because remember, I was watching the next candle, which means I got to watch all of the next candle, right? Not some of it. I have to watch the next candle or take a much greater risk. Now, remember how I had this high, this low to this high, and it was like, wow, that pretty much bounced right off of where I thought it would, according to those points. I reuse trustworthy points. Didn't come down to 24.19, which was this high to this low. Came down by that 24.84 from this high and this low. So my next set of up Fibonacci's is actually going to just shift what I'm using. I'd use this low, this high, and this low. You know what? That looks like I should probably take 25.50 calls. Because it bounced off of my target area. And as I watched that next candle, it said, hey, now I'm still going to leave this 24.19 fib here. Why? Why would I leave the 24.19 Fibonacci here? It's a really simple answer that revolves around the zero line. That zero line is still valid, right? A zero line that produced a 24.19 pullback target is still valid until what? Till it goes above it, right? Now, because of my doji candle, I had to watch the next candle, which meant this day would have been a calls buy, right? This day is a calls buy because I watched the next candle. Come 3:30, 3:45, hey, doji candle bounced off a little support area I had, went up. Doji candle tells me watch my next candle. I watched it. If I'm just going to obey simple rules, I don't just watch it, I react to it. But if it started to fall tomorrow, I've still got a valid place or valid target point for a puts trade. Sadly, this happens sometimes. And me, with the type of trading I do, I would actually probably take the 24.50 puts here. So now once I enter those, I would have the stop color red, the target I'll color green, because let's face it, it hit it, pulled back from it, right? Let me see if you guys can catch me in a mistake. Look really close at your own charts. Take a second. What do you see that makes what I just said invalid as to a simple discipline of why I wouldn't take puts there? What's the zero value for that puts fib? What's the numerical value for that zero line? Zoom in if you have to. $25.29. What is the high on this day where if I just look at it, I say, shoot, it hit that and pulled back? What's the high on that day? It was just yesterday, February 23rd. Pull up your chart. Somebody tell me what the high a day was on GE, February 23rd, 2015. Well, if it goes above 25.29, 24.19 is not a valid target, is it? Did it go above 25.29? Thank you, Eric, by the way. Okay, so that means I'd now have a visible down move, visible up move. And if it's going to pull back, it's just going to pull back to my stop for my calls, right? Isn't that what I'm showing you right here? 100% line's like right there at the same point as that red line. So basically, the target point, and actually it's 1 penny above my stop for my calls. 1 penny above. So the target point for a puts play would not even stop me out of my calls play. Does it even sound like that's worth making the puts play? Does it even sound like it's worth making the puts play? If the target sell would not even stop me out of the calls. Think about it. I would only want to take puts if I thought my calls were going to be a loser or a stop out, right? I mean, let's not think too hard. So chances are I'm not really in any danger just because it made a wee little red candle after a big green candle, huh? And then while everybody's sitting there thinking about it and debating, today happens and you would have to delete the zero line anyway, correct? That's one way that I like to do a lot of my swings, constantly kind of bebopping through them. You know, just to ask somebody that I know traded GE recently that would know. Joshua, for GE to move even from this candle here to that 25.22 target we had talked about earlier, the option's going to make 100% gain? Yeah. He knows that because that's what he got when he traded it. But with that being said, if I'm already in a calls trade because I'm making higher highs and higher lows, the only time I want to really look at a puts trade on a stock that's not making higher highs and higher lows is to do what to my calls or even my comments? Protect them or leverage them, right? It's basically on a stock that's making higher highs and higher lows, I would only want to take a puts trade to prevent me from losing money, right? It's not necessarily to gain money because in theory, it would basically break even on something, right? The profit on the puts would pay for the loss on the calls. So the goal would be to just break even if I was wrong. And if you're wrong, breaking even is not a bad deal. But if you notice, you know, a lot of people have a hard time just holding a trade for 2, 3, 4 weeks. A lot of people have a tough time with that. If you use something like visible up and down moves, even on a chart like GE, you might be trading it every 3 to 5 days. Although the trade might last for several weeks. Let's think about that. Most people, you know, I hate to say that most people think like this, but it's true. Most people think that they have to make lots of buys and lots of sells, right? Or they get bored and then they find something that they have no plan for and they jump into that. So to constantly work something like those Fibonacci extensions, not just on red candle, green candle, but visible moves, can allow you to still make multiple trades, but in an organized fashion. Now, the other things that we talked about today, some indicators, the swing points, we're going to go more in depth on those in the next couple weeks. But I want to get a little more in depth with Fibonacci extensions tonight, because they're not just fun to kind of use for your swing trades. You guys might recall that recently I did an intraday discussion and put out the video. I called it the Day Trader Medley. And one of the things that was discussed there was Fibonacci extensions. So I'm going to go to personally my most trusted intraday chart, which is a 15-minute. And I can tell you, no matter how much you trust something or whatever else, you'll still be wrong sometimes. But we're just going to find a point. There we go. Let's go 20 days. And what I want to focus on here is not necessarily what some people foolishly focus on is, did I get the lowest possible buy and the highest possible sell? I want to focus on the number of winning trades versus losing trades. So who wants to volunteer for me to just keep track of whether a trade would have been a winner or a loser? I need a volunteer, or I'm going to volunteer somebody. Okay, Trini. So all you're going to do, get a little piece of paper, write a W on it and an L on it. And as we go through the trades, you say if it was a winner, you put a little slash under the W. And if it was a loser, you put a little slash under the L. And I'm not going to keep track of these because I just want to see what you think of the results, even using them intraday. Now, I can't zoom back any further, so we can obviously see what the chart did here. And I'm just going to go to a point after the earnings. And the reason I wouldn't have done calls here is because after the gap up, it made a lower low. Now, one thing that I do, and if you go back to what we talked about on GE, there was a time it missed the target by a penny. But I go on what I call the pretty damn close philosophy. Do I get pretty damn close? So for trade number one, would I have got to a point where I was pretty damn close to the sell target? From a buy here or somewhere in here. So 115.13 is a sell target. Yes, no, maybe. Looks pretty damn close to me. Trini, chalk that up as a winner. Well, you know what? It's still a stock that had good earnings. So I'm going to mark the high, low, and high, and as it bounces here, did I get to a point where this one would have been a winner? At any point, did I get pretty damn close or hit it? Yep. Okay, so put that one in the win column. Now, I've also got to look at the fact that from this low to this low, I had a lower low. And then when it got up into here, I had a higher high or a lower high. Did I get pretty damn close to this target? I'm going to have to say, Trini, that we have a loser. And as it came up and made a move and pulled back, did I get to the point where I would have been pretty damn close on this target? Okay, put that one in the win column, Trini. Now, we made an up move and a down move. Did I get to a point I would have been pretty damn close on this target? Oh, that's another winner, Trini. And I made a higher high here and a higher low here. Did I get to a point where I'd have been pretty damn close on another target? Okie dokie, put another win on the column. Now I'm kind of ticked off because I had all of this move and my targets were a little bit shy of it. And that'll start to tick you off a little bit, but that's part of trading. Just again, so you can see the highest target we had would have been this one. Now the other thing we got to look at is we make an up move here. Actually, we make a up move here that gaps down the next day. Now this is about 30 cents, I believe, below the target. 20 cents. I'm going to say that's really not pretty damn close. And sadly, while we were probably waiting for it to hit the target, I wouldn't have sold it, and I'll be honest about that. So it would have made me sell it right here, wouldn't it? Why would it have made me sell it here? Yeah, it failed the zero line. So guess what? Put one in the loss column, Trini. I also have a low, a high, and a low here. Did I get pretty damn close? Nope. There's another one for the loss column, Trini. Well, you know what? It's starting to tick me off a little bit, right? Had a couple losers there after a couple nice winners. Would I've gotten pretty damn close here? Okay. Before you put the win in, I want you to see that there's actually a few trades here. Another low or high, low, high. And then I also got to say, that looks like it's all one visible up move, which means this was the high from it. All one visible down move, all one visible up move. Did I get pretty damn close on all three of those? Trini, give us 3 wins. Now, the next thing I got to look at as time goes on is here it kind of makes an up move. Did I get pretty damn close there? No, but we don't know if it's over yet. And then what we also have, because we still have a stock with good earnings, and we still have a stock that from this last low gave us another target. And also, right here, and we haven't failed the zero line, but did we get pretty damn close on this one? I'd say that's a yes. Give us a win, Trini. Now we'd be in both of these ones still. We'd actually get another one there. Starting to look like it just started making higher high, huh? That could be a higher low. So we'll enter that one too. That get us pretty damn close to our target? Give us a win, Trini. Then is it also possible, because this was the area it stopped making lower lows, that we have this as well? Oh, give us 2 losses, Trini. 2 losses. Did we hit our target? Give us a win, Trini. Now, if you're like super scalper, you could say, oh, hey, let me try to take puts here. And you'd see, you'd get a win on it. But I don't want to count this as a win. Because if the stock's making higher highs and higher lows, you shouldn't be looking at the puts. So we're not even going to count that as a win. Got a low here, high here, a low here. So now we'd be in 2 trades. Shoot, just got stopped out of one. Put that as a loss, Trini. Now I got to kind of wait for it to break this high. There, it did it. Starting to look like I made an up move and a pullback. As soon as I break that point, you bet your butt you turn around and put this to here. And then you got to ask yourself, do you really have enough room? Now, if you're trading, let's say you're doing $500 or less, don't trade anything without a dollar move to your target. If you're trading a couple $1,000 in each one of these, you're going to make 10 to 15 cents to your target. Did I hit my target? Give me a win, Trini. Did I hit my target? Give me another win, Trini. Did I just make a visible pullback? And a positive move from it? Give me a loss, Trini. Give me a second loss and a third loss. This is where you've got to be resilient. This low, is it lower than this low? But we also have to be aware that we're still higher than this overall visible up move. We're going to have to keep aware and stay resilient. If you want to be day trading, resiliency is key. Yep, that's going to be a loss. It went above there, so that's a loss, Trini. There's another loss. Hate it when that happens. And we would have actually, I went one too far on it. Hold on a second. Where am I at? There we go. Sorry about that little glitch. Right there is where we would have entered this one. Did we hit our target? Give me a win, Trini. Now we also got to look at the fact that we made a lower low here. And also, and it wasn't until this candle that I would have drawn this and said, okay, now, like I said, if you're trading with a couple $1,000, you can make this trade. $500 or less, not worth it to you. That'd be a loss. And another loss, sadly. There was a few days where this was a pain in the butt. We would have had a target there. We'd also be looking for the next high to take a put trade on. And we would have taken a loss on the calls. And this one, ironically, got pretty damn close to your target there. Actually, 3 cents from it. That's pretty damn close. We're going to count it. There's a win. There, it would have hit it anyway. Now we still have lower high, lower low. And a stop out, which, hey, that happens. We would have had the win, but also a loss on the puts. That would have given us a loss. Oops. Now one like this too, these type of targets I wouldn't enter until it breaks this last high. which it did there. But we'd have had 1, 2 wins. So far, that looks pretty damn close. Let's see how close. 5 cents is pretty damn close if you ask me. Now with the higher high, I'm not necessarily looking for puts. I'm looking for a bounce point. So that's not a win. It's just because I marked it. Might have been 1 win, 2 wins. And this is kind of where it screwed me. Because if you remember, this is where it kind of took off and got away. Because I really didn't have a point to go off of. Because I didn't when it was happening, I'm not going to mark it and act like I did. There's a visible pullback. Just going to wait. I always wait until it breaks that other high. So, okay, there would have been your entry. There's another win, and that screwed me again. You keeping track of all these, Trini? And again, always let it break that other high. Unless it actually pulls back to the point you were marking and waiting for. And I don't have at this point on this chart, I don't have a reasonable area to try to replicate a pullback. So I'm waiting and waiting. Yeah, that looks like a lower high. I think I made this put straight. Didn't like the result. Now here on the break, that would have been a loss. But it finally gave me another point, which sadly I wouldn't have been able to get it. So that one wouldn't have counted because you wouldn't have gapped up right to the target and you wouldn't have been in it. And that would have been right on that break. So far, pretty darn close. There you go. There'd be another winner. And you would be in this one, by the way. That one you'd already been in. Now is where the guessing game would have begun. Because I, for one, couldn't really justify putting fibs here. But, so we're not going to count that because I don't think that'd be a good thing for teaching process. There's a visible pullback. I would use 2 points here. This one.
And also this one. And I wouldn't make the entry till it made this last or broke this last high. Because remember, I'd still be in this one. Okay, so it dropped below. So we'll just have to wait till we can remark it. Right here. I think it just gave you an entry. That one, there's no way I could have traded that, so we won't count it. When it broke that high, though, and it didn't break that high until it hit the target, so that wouldn't have been tradable. Got a visible pullback there. Okay, this one would not have been tradable, but the other one would have on that candle's break right there. Okay, so there's another win, Trini. Another win. That's obviously pretty damn close. That's right on it, so that'd be win number 3. Sadly, I don't think I had any points higher than that. Oh, and then it kept going. You notice this was the dilemma. It really didn't give anything. Here you'd have had a far from educated guess. But again, no visible pullback, and that's what we were looking for. Here you had a visible pullback. So this one would have been tradable. There would have been another win on it too. I think because of the 2 visible pullbacks. You went below it, so. But there, oh, didn't break above yet. Did there, so we'd have gone here to here to here, and by the time you got the break, it wouldn't have been tradable for me. And that was today. This one, by the way, wasn't one we were in because I said that's not tradable because it didn't make a visible pullback. So here, you know, sadly, the last like $3 up, actually yesterday. So yeah, a full $3 or more up. There's nothing really on it to judge from, but we did get a lower low. And you'd have had 2 things to judge on. You could have gone all the way down here to this, and I'd have probably said, yeah, go ahead and make that entry.
And sadly, you probably have to make that one if you're using this as your system. And then here, you'd have been making this entry. Now, none of these three do we actually know if they're going to be winners yet or not. Now, Trini, what were the wins and losses as we went through just the last 20 days? And sadly, there were about 6 days that were a pain in the butt. But what were our wins and losses there? These last three, we don't know the result on, so we can't track that. But 25 wins and 15 losses. Now, that might sound horrible. And if you're just tracking percentage, yeah, it is. But in reality, if you're stopping out at your zero lines, and if you look through how many of those target points for the wins were pretty good wins, if you attack that every single time, even in the way I just walked through it like on Apple, well, that was 20 days worth of time, and actually it was only 17 days worth of time frame. Most of those losses came in that 6-day period where it was a pain in the butt. But if you traded that with the same amount of money each time, and let's just assume we're going to do like generic stupid math. We're not even going to say like 100% win, because I know that on about a third of those wins, it would have been about 30 cents. And let's say that on your 25 wins, you made 30 cents per contract. How much did you make? $7.50, right? And then let's look at the 15 losses. I'm just going to put in there that you would have lost the same 30 cents because your qualifier, it's not like it was going to be a 50% loss or anything from your zero line. You would have lost $4.50. Now, you guys saw as we walked through it how many of those wins were actually like $5 moves, big gap ups, stuff like that. But just using a very simple assumption, if you bought 10 contracts every single time you did it and took 30 cents on every win, 30 cents on every loss, would it have been a productive system in the sense that you'd be sitting now with more money than you had before? And you could say, oh, well, that was easy. You know, Apple basically went straight up, and you guys know that those weren't just 30 cents wins. But you could go to a stock like Facebook. And using visible up and down moves. And we don't even have to go through all of it to just kind of low, high, low, low, high, low. That one would have been a quick, easy one. This one, not quite, but it's within 10 cents. Pretty darn close. On your double top, you'd have smacked right on it on that low. And remember, trading isn't about getting the lowest buy or the highest sell. If you simply focus selling at your target point for a trade, investing's different. Trade it in relation to your stop. Keep moving your stop up. But hitting and without question,
And you can see the points that I'm marking. Now, you can see like even on one like Facebook, even when it was kind of going sideways a few days, that most of these would take at least a full day, if not a couple days to hit, right? You could keep your trade rules really, really simple. If it needs if you're trading a stock that's $70 or higher, and it needs if your target is $2 or less away, trade the same week. And if it's $2 or more away, trade next week's. Trade a strike that would go in the money by your target point. And you could literally whittle away on a chart, just pop, 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 with the Fibonacci extensions. Just like you can with like the 50-50 system, just like you can with about anything else. Now, what I'm going to be doing, because this is 100% an educational service where I share my buys and sells, I'm still going to do my 50-50 trades the rest of the week because I like those. But to help people learn and understand, we're going to be tracking a single stock from now until next Tuesday on an intraday chart with Fibonacci extensions. And I'm going to make every qualified buy and sell at every target point. Now, what I would tell you is the smart thing to do would be to simply observe that being done, see what your thoughts are on it, and after that week-long period, decide if that was something that you would want to apply to your trading. But starting tomorrow morning, for my time in the chat room, I'm going to look at making qualified buys with Fibonacci extensions on a 15-minute chart. Buy when it says buy, sell when it says sell. And I really, really encourage you to spend that first week observing it, maybe taking some notes like a little journal. What were your thoughts of it when he did it? I was a little skeptical of this buy. Yeah, it was really simple, Richard. It was one of two things. If I had, like for a calls play, if I had a downside Fibonacci, a pullback target that it made a positive move from, I would buy on that positive move. Otherwise, I would wait till it broke a high point. Real simple. I mean, for example, like on Facebook, if it was doing something like this, well, I wouldn't have bought like down there, but when it broke this high point, I'd have marked something like this. And I'd have seen it go up, and I'd have probably been ticked at it for a moment. But I also would have had something like this. Oops. A little bit of puts that didn't get close enough, so I wouldn't have bought that. When it broke another high point, and even that would have been like right here, I'd have bought with this target. And you see it got a little kooky. But right here would have sold that one. Right here would have sold that one. But there would have been, actually in that case, there wouldn't have been another point. And that's basically what I'm going to go through over the next week.
You can't do it on a 15-minute chart with GE, Sam. Thanks for paying attention when I was actually talking about GE. No, Ryan. I'm going to use the same ones I just mentioned about 2.5 minutes ago in the video.